Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, the crude oil market has been on a consistent uptrend for the past couple weeks. Right now it's getting back some of those gains as it has traded into the upper area of this channel. Overall, I do anticipate some support right down here at not necessarily the bottom area of the channel, but I'm looking more towards that 20-day moving average. The percent K did break down below that percent D area, and that's basically the convergence between whether or not markets will eventually pull back. It gave back some of those gains, but it looks like it seems to be a bullish flag pattern, and I don't even think 104 will even be activated as far as crude oil is concerned. We had a huge volume upsurge, and that's basically a liquidity trap. And a liquidity trap is basically where markets have a lot of liquidity, they trade up because there's a lot of volume, and eventually all that liquidity dies down. There's not a lot of whole entire volume, there's not a whole lot of buyers' interest in the futures contract, and what happens is people tend to panic, they start selling, and all of a sudden you get a minor pullback. But right now volume is relatively low, and the lower the volume is, generally speaking, it implies that there's going to be future upside potential. Extremely low volume is the opposite of a liquidity trap. It means it's a liquidity squeeze, I think. I don't really know the terminology, specific terminology for it. There probably is, but I'm just going to make something up right now. And a liquidity squeeze is basically where there's hardly any contracts being traded. All of a sudden there's a sudden instinct or urge or a need for a major institution to go off and buy a bunch of contracts in order to hedge, or not really hedge, but to speculate on more upside potential. And all of a sudden you'll see this huge unwinding effect where all of a sudden there's not a lot of contracts being traded, or pre-existing E-mini contracts being traded on the crude oil market, and all of a sudden you'll see a huge gap up in crude oil prices. So right now we went from a liquidity trap to a liquidity squeeze, and right now we're in the phase where markets are kind of squeezing in because there's hardly any buyers' interest right now, and all of a sudden markets are going to scoot higher. And that's typically been the case with crude oil. Every time you see low volume, you can anticipate a rapid move to the upside in a very short duration of time. Also, I want to mention that even though the volume was relatively high for a short duration of time, it wasn't a typical liquidity trap because there wasn't a very major pullback. If you only drop by 1% after a liquidity trap, where investors were basically investors were stuck with a bunch of contracts and there wasn't a whole lot of volume to absorb any selling. Typically people panic much more and they tend to sell a lot. Right now, you didn't see a whole lot of contracts being exchanged, and you didn't see a whole lot of price action sending the market lower on crude oil. The fundamentals, though, overall imply, again, long-term uptrend. Crude oil prices, the higher they go, the worse it is for the economy. Overall, the United States is a net exporter, not an exporter, but a net importer of crude oil. So any benefits seen on one end of the spectrum from the oil companies will not be felt by the economy as a whole. The main reason is because all that excess crude oil that's being bought by the U.S. citizen is actually being bought by foreign companies. And because of that, if you see a rise in prices of crude oil, it only benefits oil companies. If the vast majority of oil companies that are selling crude oil to the United States aren't even U.S. companies, then it will have a limited impact, or it will have a negative impact on the U.S. economy as a whole. And because of the rising oil prices, people will have less money left to spend and buy goods and services, and of course the cost of transporting goods and services will go up, which will mean margin erosion and revenue erosion. Both the top line and the marginal aspects will be negatively impacted from a corporate standpoint. So overall, higher oil prices cannot be a good thing for the U.S. economy and not for the U.S. corporation or the typical U.S. corporation. As for oil companies, though, they will experience, I guess, a rising tide, or the rising float will benefit all of the oil companies. But again, oil companies represent a big portion of the United States economy, but not enough to account for all of the U.S. economy. And that's really the issue and the distinguishing fact behind why crude oil prices going up is bad. And even if you see oil companies make more in profit, it doesn't really mean anything because the vast majority of crude oil that's bought in the United States isn't being bought from those oil companies that are traded on the U.S. exchanges. So again, Chevron, ExxonMobil, great for them, but not good enough to account for the whole economy. Okay, so let's move on to the next chart, which is going to be the U.S. dollar index. U.S. dollar index has been trading relatively flat for the past 4 or 5 consecutive sessions. overall, a lot of technical analysts and analysts in general are anticipating markets to eventually push that US dollar index up. The main reason is because the Euro US dollar index, Euro US dollar is trading into the upper range of its channel, and I do eventually see it pulling back. Because it's going to pull back, you're going to see a nice little bounce in the US dollar index. And the main reason is because the Euro US dollar is 50% weighted on the US dollar index. Any pullback in the Euro US dollar would imply immediate strength for the dollar index, and if you see a pretty significant rally in the dollar index, that will lead to a pullback on the Dow component or the Dow Jones Industrial Average. Right now, the Dow Jones transports have already pulled back, as I will go ahead and show you in the IYT chart. And right now we're sitting, let's pull back a bit. We're already pulling back on the transportation, and some issues with the transportation index is the fact of rising oil prices. Rising oil prices will immediately have a negative impact on the transportation stocks, which again represents a pretty big share of the economy. You're talking about companies like BNSF and stuff like that, which are the railroad companies. And basically, you're already seeing a negative impact on the transportation companies, the transportation side of the Dow Jones. Because transportation is already pulling back, you can immediately imagine, at least according to Dow theory, transportation goes first, the rest of the herd goes later. So again, Dow Jones Industrial Average will eventually follow the trend you're seeing in the Dow Jones Transport Index. Because you're going to see a pullback pretty soon, perhaps in the next week or the next couple weeks, overall, not too good for the Dow Jones. We haven't been able to close above that 13,000 for 5 consecutive sessions, and that's not very good. There doesn't seem to be a whole lot of momentum behind this. And typically, in a low volume rally, as you guys can see, $100 million of volume, typically markets have no problem going higher. And the main reason is because people are generally afraid of those liquidity traps where you have a lot of volume, and basically there's a lot of trading going on, there's a lot of activity, and all of a sudden the volume drops and you're left with stock and you can't turn around and sell them because there's not enough liquidity out there. And people generally avoid liquidity traps. So the opposite of that is a liquidity squeeze, where there's a total absolute lack of liquidity because there's hardly any trading going on. All of a sudden, when somebody decides to buy a lot of shares, there's not a whole lot of offers out there, and all of a sudden the stock prices gradually get bid higher and higher and higher. That's a liquidity squeeze, and we've had that for the past 8 months. Whenever we have a correction, you see a huge surge in volume. But otherwise, the volume has been relatively weak the past couple of weeks. If we ever see an increase in volume, chances are that's going to imply overall pullback mentality. And right now, a lot of people are anticipating a pullback as is. Therefore, personally, when I think of stock indexes and stocks in general, I'm looking to short stocks that are overpriced to the extreme, high beta plays, cyclical stocks that, again, that are very overpriced from a price to earnings standpoint. Pricing is very important, and it's just simple valuation models. I mean, you just look at it. If it's priced too high to be too good to be true, chances are it's going to pull back. As for the stocks that are non-cyclicals, those are going to do fine. I think the non-cyclicals, companies like oil companies, those will do okay. Food, agricultural companies, stuff like, I guess, Kroger's will do fine. When I think of it, McDonald's, restaurants will do okay. Basic stuff, just the non-cyclicals in general will do okay. But the cyclical stocks and the ones that are higher beta, higher price to earnings multiple stocks will have a pretty significant pullback. And when the Dow Jones pulls back by perhaps 5 to 10%, you can see those higher cyclical, higher flying companies to pull back from anywhere from 20 to 30%. Typical correction behavior. And again, I am overall bearish for the short term, but over the longer term, I am optimistic on the stock indexes and the stock market. Standard & Poor, again, interesting chart here. Initially, we were down at the very beginning of the session, and then we pulled right back up, but not enough to break the 13,000 area or 137. I want to go ahead and zoom back in and talk about this real quick. 12,900. We opened at around 12,974. Pretty volatile day towards the front end of the session, but overall we kind of pulled steady Eddie. So again, not much more to say here. Sell off, float back up, and again we might experience more sell-offs in the future before again you have a nice little float back up. But again, markets don't go on upwards forever. Eventually, we do anticipate a pullback. It's just a matter of when, not if. Okay, we already analyzed the Euro-US dollar. Let's talk about the volatility index real quick. The volatility index has been able to see a pretty decent run, seeing a decent run right now. But again, we've seen this in the past where it would go fits and starts, fit and starts. Right now, this could be a great opportunity for the volatility index to finally breathe some air and perhaps go a little higher. The main reason is because, again, the Euro-US dollar is trading into this channel area. If it pulls back, don't be surprised. You're going to see a rally in the US dollar. Rally in the US dollar would imply Dow Jones Industrial weakness and Standard & Poor's weakness. And if that were to happen, the volatility index would go up because volatility is basically falling stock prices. Falling stock prices means more volatility, and the volatility index will benefit from that. Gold prices have been pretty mute again. Overall, we could probably see much more upside in the gold market. I wouldn't be surprised. Overall, the gold market will continue going higher, but overall, when I think of gold, personally, gold is just a way to hedge against inflation, but it's not going to outperform companies that generate dividends, that grow. Those kind of equities gold will not outperform those over the long term. Gold is just a stationary asset. It should be seen that way. It doesn't produce interest. It doesn't produce any growth. Therefore, gold could keep up with inflation. I can see that happening. But what I don't see gold doing is outperforming dividend-producing, growing companies. I just don't see that happening over the long term. Silver has had a pretty decent run, trading at around $35. We're seeing an uptick in the monthly chart for the silvers, monthly trade triangles. Overall, silver is pretty decent. Gold is pretty decent. I am optimistic over the short term for gold and silver, but I place it in a category where it will not outperform dividend-producing businesses that are growing on a consistent basis. I have to say, cyclical businesses, maybe silver can do a little better than cyclical businesses or poor-performing businesses, but for the stalwart businesses that are doing a great job growing and making money and giving out dividends payments and growing their dividends, silver and gold will not outperform those, even though silver and gold have their place inside of a portfolio. That does it for me for today, guys. If you have any questions, leave a comment right below.